Welcome to this presentation on the balance sheet equation, a fundamental concept in accounting and finance. In this lesson, we'll explore how businesses and individuals use the balance sheet equation to represent their financial position. By the end, you'll understand how capital raising activities are reflected on the balance sheet, be able to define assets, liabilities, and equity, and apply the balance sheet equation to real-world scenarios. Firms raise capital to then purchase assets to run the business. When starting a business or making a major purchase, you need to decide how to finance it. You can use debt financing, where you borrow money and promise to pay it back with interest, or equity financing, where you use your own money or sell ownership stakes. The balance sheet captures this financial structure, showing you the assets you own on the left and how the assets were financed on the right. Assets are resources that provide future economic benefits. They're things of value that you own or control. Assets represent what you've invested in to generate value. Assets can be tangible, like cash or equipment, or intangible, like copyrights or goodwill. Common examples of current assets include cash, accounts receivable, and inventory, but typically when we think of investing, we think of longer-term assets like equipment, buildings, and financial investments. Liabilities are obligations you owe to others and represent debts or amounts that must be repaid in the future. Examples include loans, mortgages, accounts payable, and credit card balances. Liabilities show how much you've borrowed to finance your assets and represent creditors' claims on the company's assets. We think of it this way because this is the amount or portion of the assets that creditors would own if the company were liquidated. Equity represents the owner's stake in the assets after all liabilities are paid. When we measure equity, we can think of this as the true ownership in the firm. Equity can include initial investments, retained earnings, and additional capital contributions. When a firm issues stocks, that gets booked on the balance sheet under the equity account as either paid in capital or common stock. And then, as the firm runs its business, the additional profits that the company earns through its operations belong to the owners. If the firm does not pay out those earnings, and they retain them instead to invest back into the business, the earnings that are retained get added to the owner's equity on the balance sheet under retained earnings. Let's start with a really simple personal finance example to show how we can use debt and equity to finance an asset. So in this example, we're going to purchase a home for $100,000, and we've saved up and are going to put down $20,000 of our own money, so that will be the equity that we have in the home. Now, to purchase this asset, we need to borrow $80,000, and we'll book that as the liability on the right side. So again, we place the total value of the asset on the left and then how it's financed over on the right. That right side shows what portion of equity versus debt that we're using to finance this home. Let's take a moment to appreciate and understand the balance sheet equation. Assets equal equity plus liabilities. This equation must always balance. Everything you own, your assets, is financed either by your own money you put in or what we call equity, or by borrowed funds resulting in liabilities. Now, let's assume that we just purchased this house, and we're in a very fast-moving market in which home prices are quickly rising. A nice couple is moving here from New York City, and before we've even paid the first mortgage payment, they say, "Hey, we like that house too, and we'll offer you $120K for it." If you bought this house for $100,000 and could turn right around and sell it for $120,000, how much equity would you now have in the home? The balance sheet will always balance. So we can use this balance sheet equation to back out the amount of equity that we now have in the house. So think about it this way. If we were to sell the house to this nice couple for $120,000, we can pay back the $80,000 loan to the bank, and we would have $40,000 left over as basically our equity that we get to walk away with once we cash out or liquidate the asset. Let's look at another example. If a company has assets equal to $1 million and liabilities are $600,000, how much is the firm's equity? Rearranging the equation, equity equals assets minus liabilities. That's 1 million minus 600,000, giving us $400,000 in equity. An important note about reporting the value of assets on the balance sheet. In personal finance, we typically report assets at market value, what they're worth if we sold them today. However, under U.S. Generally Accepted Accounting Principles, or GAAP, businesses often report assets at historical cost, what they originally paid. In personal finance, we can report the market value of real estate on our balance sheet because we're not subject to the generally accepted accounting principles as an individual. We don't have to use accrual accounting, and we don't have to follow GAAP. And this difference affects how equity is calculated and reported. An important takeaway to note here is that equity is not equal to cash. It's not a cash account that is sitting there in the firm. It's representative of the ownership in the firm's assets, and not all of those assets are liquid. So we would have to actually liquidate the asset to get the equity out of the firm. So think back to the house example. We don't actually get to recognize that $40,000 until we sell the asset. Note that equity can be positive, negative, or zero. Negative equity means you owe more than you own, a situation called being insolvent. Equity increases when you add capital or generate profits, and it decreases when you withdraw money or incur losses. To summarize, we've learned how assets are represented on the balance sheet along with type of financing, debt or equity used to finance those assets. We've defined assets as valuable resources, liabilities as obligations owed, and equity as the owner's residual interest. We've applied the balance sheet equation, assets equal equity plus liabilities, to solve real-world problems. These concepts form the foundation of financial accounting and help you understand any organization's financial position. Thank you for joining this presentation on the balance sheet equation.